But we're going to get moving. We've got a pretty busy agenda later this morning. We've got some excellent speakers. And of course, my comments are interesting to a certain degree, but I know you're all looking forward to seeing some of the acreage numbers and the price numbers that we're going to be putting out here this morning in a couple minutes. And I'll be sure for those of you that are taping this for radio to read out all of those numbers in their excruciating detail. Okay, again, I would just like to echo the Deputy Secretaries and Secretaries' welcome to you again to this 94th Annual Agricultural Outlook Forum. Of course, our theme this year is Roots of Prosperity, which keys off of some of the Secretary's comments about our travels this summer, heading back to hear what producers were saying about the roots of farm policy and what they're concerned about out there in the countryside. The annual forum obviously is an important opportunity for all of us at USDA to discuss some of the upcoming challenges and opportunities we see on the horizon. The Secretary talked earlier today about tax and regulatory reform, infrastructure investment, and efficient and effective farm policies. Our key speakers later this morning will also talk about current year challenges and opportunities facing industry, states, and of course nations, with our speaker following me, Dr. Adesina, who will be giving a global perspective. Tomorrow morning we'll hear again from Deputy Secretary Sensky, Under Secretaries McKinney, Ibach, and Hazlitt, who will be describing the coming year for trade, regulations, and rural development in more detail. And I hope you all join us tomorrow morning for those comments and some question and answer. So, for the U.S., of course, we know that producers have many questions looking to the 2018 crop year. We've got a new farm bill. We've got the Bipartisan Budget Act changes to some farm policies. We've got, of course, as part of that, disaster relief, and farmers are interested to know how quickly that relief will reach them. We've got questions about trade. And if we start by looking at this first slide here, at several surveys regarding consumer and producer sentiment about economic well-being over the next 6 to 12 months, we focused, this is a slide I showed last year, of course, we look at the Purdue CME Ag Economy Barometer, the University of Michigan Index of Consumers, the National Association of Home Builders, the Federal Reserve Ag Credit Survey of Bankers, and of course the Creighton University Main Street Survey. And we also, of course, plot against that the price expected to receive for a bushel of corn on the farm. We can see that consumers, businesses, home builders, and bankers all indicate similar feelings of optimism regarding the future economy. And that's, of course, compared to last year. Now, this is when we normalize by this to a time, so a year ago, sometimes it may show up optimism when indeed some of these surveys are actually revealing negative expectations. Nevertheless, relative to last year, they are positive. Farmers are a little bit more reflective, tracking more closely to the price of corn since this time last year. We expect farm income to fall. Why is that? Well, falling net farm income is largely, as you all know, the result of falling commodity prices. Productivity is outpacing population growth and food demand. This has resulted in falling real food prices for the past half century. For example, look at this. Since 1960, soybean production has increased more than 1,000%, while real soybean prices have fallen by 47%. It's just amazing. Corn production has grown by more than 400%, and prices have fallen by more than 60%. What does that mean? Well, today's ag economy is also different, of course, from when Congress debated the last farm bill. Here we show real net farm income falling in real terms. It's likely to remain 50% below its 2013 peak for a third year in a row. And looking forward, of course, we expect it to remain flat. And there are several things that may change this outlook. But I'll just note that 2 weeks ago, USDA's Economic Research Service estimated 2018 to actually be even a little bit lower, as the Secretary mentioned, with net farm income falling to $59.5 billion. What might improve that income? Well, we know that cheaper food benefits global population demand, but also pressures income for farmers. There are some things, of course, that can change that. First, improved global economic growth will mean more middle-class families, and that will boost food demand. Improved trade agreements will open up markets, increase demand for U.S. product. And of course, weather conditions will affect global production and push up or draw down prices. As an example, think about dryness in Argentina. It's been pulling down our estimate of the soybean crop there, pushing up prices, whereas beneficial rains in Brazil, shown here on the map, have pushed up estimates. Also, foreign policies in some countries could affect prices. We know China's attempts to reduce artificially inflated commodity stocks has had effects on prices here in the United States. And lastly, the new Farm Bill and the Bipartisan Budget Act will also look to remedy some of those gaps, with the processes already begun, as I mentioned, with that legislation. The prospects look good for increased demand since our December projections. The IMF has raised its 2017 to 19 growth forecast sharply in January, showing market growth in the last year and continuing stable over the next few years, and that should help boost demand. The aggregate purchasing power for the globe essentially expanded by $325 billion compared to our estimates back in December. As we know, much of the growth in global demand will be in developing countries. The Secretary mentioned that this morning. We're expected to see a significant increase in the number of middle-class households over the next 10 years. As middle-class income increases in emerging markets and developing countries, we expect demand for U.S. product, especially livestock and dairy products and the grain and oil seeds that make up livestock feed and processed products, to increase. The number of middle-class households in China will nearly double, approaching 370 million by the year 2026. And the number of middle-class households in India is expected to nearly triple by 2026. Stronger growth overseas means increased stability in other countries, which makes them a more attractive target for investment. And for countries that buy U.S. agricultural goods, we see more stability in 2017 and 2018, with the dollar falling so far against those currencies. The dollar did gain against the yen, which, as we've known, Japan has had some sluggish growth there. The Mexican peso has been hit by rising inflation and concerns over NAFTA. And the Chinese yuan has suffered from capital controls and slowing growth early in the year. But the Canadian dollar has appreciated as petroleum prices have risen. The Taiwan and Korean currencies have gained also with respect to good investment and faster than expected trade growth. For countries that compete with the U.S. for export markets, we saw more stability in 2016 and appreciation against the dollar in 2017 and 2018. The exception, of course, being Argentina. Argentina's peso still suffers from high inflation and an uncertain policy environment. The ruble owes its appreciation in 2017 so far and in 2018 to a bounce in oil prices. And Brazil's economy has benefited from improved fiscal policy, lower inflation, and higher raw material prices. A more stable government there has helped boost the real so far in 2018, but the October 2018 general election may introduce some variability this summer. As mentioned, increasing ag trade remains a key component of the future growth in the agricultural economy. In general, improved global economic conditions, a slight weakening of the U.S. dollar, resulted in a $10.9 billion increase in the fiscal year 17 exports compared to 16. FY 2018 exports are projected near, as the Secretary mentioned, FY 2017 levels at about $139.5 billion, and the ag trade surplus is forecast to narrow slightly to $21 billion from $21.3 last year. Of course, trade agreements are an important component of our forecast looking out, and we know that free trade partners account for almost 45% of U.S. ag exports now, and that includes Canada and Mexico, but also South Korea, Colombia, and other Latin American countries. And they've become an increasingly important component of U.S. trade. U.S. ag exports, of course, continue to be dominated by China and our NAFTA trading partners, Canada and Mexico. I'll just note that U.S. exports to China are projected at $21.6 billion this year. And I'll say, I would say, tune in tomorrow for Undersecretary McKinney's discussion on upcoming trade items. Hopefully his flight will arrive on time. All right, let's turn to the U.S. crop forecast and the major factors influencing the market for crops in 2018 and look at the prospective area and prices. I'll just note that in tomorrow's commodity outlook sessions, our analysts will offer a much more detailed look at USDA's projected balance sheets for the 2018-19 marketing year and provide an update to estimates in the 10-year baseline projections that we put out earlier in December. Let's start by looking at stocks relative to use. First, production has outpaced consumption for many grains and oilseeds over the last 4 years. We've had great harvests, both in the U.S. and abroad, recovering in part from the large drawdown in stocks we saw following the 2012 drought. Global rice and wheat stocks relative to use are approaching highs not seen since the early 2000s. Soybean and corn stocks to use are also up relative to the lows we saw 8 years ago. The combination of rising stocks, continuing large global production have limited upside potential for prices. However, we do expect an increase in demand relative to production in the upcoming year. Wheat prices are expected to rise modestly to $4.70 a bushel, up 2% from last year, in part as last year's drought in the northern plains and current dry conditions across much of the winter wheat areas have supported prices despite large U.S. and global stocks, as I showed earlier. Soybean prices forecast at $9.25 a bushel are expected to be down fractionally next year as large U.S. stocks hold prices in check. Cotton prices rose slightly in 2017-18 even as producers in the U.S. and around the world expanded area. Cotton prices in 2018-19 are projected down almost 9% to 63 cents per pound. The all rice price is forecast to fall less than 5% to about $11.90 per hundredweight, down from last year's price, which had been supported by sharply lower U.S. area. And driven by record yields in 2017, corn prices ended the year down at $3.30, but looking forward, we expect a small rebound in prices as we return to trend yields, up 3% to $3.40 a bushel. Of course, we know there are multiple factors that could affect those prices over the upcoming years. Longer-term projections that we use for budgetary purposes often indicate relatively flat prices over the 10 years, but of course we know just from looking at this slide that that doesn't always happen. Prices up or down will depend on weather and the economy and a lot of conditions that we can't forecast right now. There can be shocks from drought to global GDP changes, which will influence where the prices will end up in any given year. For example, looking at this slide, if we look more closely at our corn price estimates for the year 2020, we see a potential lower bound price of about $2 a bushel, very low of course, and an upper bound price at $5.50 a bushel. So all of our simulations end up, roughly 95% of them end up in that range. Lower corn prices, as this example shows, will coincide with higher ending corn stocks, along with yield outcomes far beyond what we currently have for the expected national average. Higher price outcomes conversely reflect scenarios with low yields and low ending stocks, and high prices for feed substitutes such as soy meal. We also know that prices and ending stocks will be influenced by our ability to trade. For example, we know that China's corn support and TRQ administration policies led to higher import demand for other feeds such as DDGs and sorghum, pushing up their prices. In late 2014, China began temporarily rejecting U.S. DDGs due to presence of unapproved biotech, dropping the price. In late 2015, China began probing U.S. DDGs for subsidies, and in January 2017, China imposed anti-dumping CVDs on U.S. DDGs. That had the effect of increasing the prices of those feeds higher than the price of corn when China's demand was strong, and the opposite when China imposed those trade restrictions. But of course, farmers will plant based on base their planning decisions not on prices alone, but on relative prices that they see in the market in the spring when they're going to plant, or in the fall when they're buying inputs. When prices look to spring planting, we have seen, look as an example, one thing we look at is the soybean to corn price ratio, and roughly it's sitting at where it was this time last year at about 2.6. Of course, last year we saw more than 6 million additional acres of soybeans planted. And of course, the question will be this year is, with the acreage of corn and soybeans nearly equal in 2017, is there room for further soybean expansion at the expense of corn? So if I had a clicker here and I'd ask you all to text in your answers to that question. Or do we see agronomic and rotational issues limiting the ability for soybean area to overtake corn by a significant degree? I'll ask our Deputy Secretary to opine on that. Maybe not. All right, let's see what we see. Here's our acreage look for 2018. With commodity prices flat to slightly rising from last year, we expect acreage to remain similar to last year's acreage. For corn and soybeans, the current price expectation, combined with rotational constraints, do push the combined area to 100 million acres, evenly split between the two crops. So we can't choose which one we like above the other. 90 million acres for corn, 90 million for soybeans. We expect the continued expansion of trade in soybeans, however, will continue to put pressure on corn, but more likely other crop area in the future. Our latest long-term baseline suggests that soybean area will match or exceed corn area for much of the next decade, supported by import demand from China. Wheat acreage is expected to reverse a 4-year trend and expand slightly. While winter wheat seedings for 2018 were essentially flat, current price strength in spring wheat suggests that we could get some expanded area in the northern plains. Cotton area is expected to expand by over 5% as the last 2 years have seen favorable prices for cotton. Rice area is also expected to expand slightly up from 2017. And I'll just say we do see other feed grain expectations also moving up slightly, although we'll wait to see what our planning intentions look like in March before we settle down on our final balance sheets. But in summary, with commodity prices flat to rising and input prices from nitrogen to land rents to flat to falling, we expect a slight expansion in the overall 8 crop area. I think it's worth noting the dominance of China in the soybean market will not only continue but grow in importance over the next decade. While we see more subtle changes for coarse grains and wheat and a much more diversified set of destinations. For soybeans, the story continues to hinge on China, which accounts for 65% of the total trade in soybeans. North Africa and Middle East currently account for between 20 and 30% of the trade in coarse grains and wheat. And we'll look out 10 years to see who will be buying in the future. Those trends are likely to continue with continued growth in soybean sales to China and grain sales to Africa and the Middle East. The U.S. export share of global trade will flatten but remain critical. We know that we saw a decline in the U.S. trade share over the last several years, but that decline is expected to slow. With our aggregate farm area, it remains largely constrained by production gains driven by increasing yields, which can vary from year to year. And we did note the rapid expansion of domestic ethanol production between 2007 and today. Our trade share in several commodities fell. And we know, of course, for soybeans, continued area growth in South America will erode our trade share and be affected as well by the need to supply increasing domestic crush demand. All right, let's turn to livestock and dairy next. The outlook for livestock and dairy is for continued record total meat and dairy production going forward. With low and stable feed costs over the past few years and projected going forward, the outlook for livestock and dairy is for another record year of production. We project that total meat and poultry production will hit nearly 104 billion pounds in 2018 as production of beef, pork, and broilers all increase. Milk production is also expected to be at a record 218.7 billion pounds in 2018 with modest herd expansion and stronger growth in milk per cow. The rate of growth in pork production is near term and will likely reflect demand for slaughter hogs due to increases in slaughter capacity. Broiler production also expected to rise, but maintain steady through the growth of the next 10 years. Let's look at beef real fast. Beef production expected to grow rapidly in the near term. That's shown by the green bar there as a balanced growth between supplies and demand. Current projections for domestic beef supply exceed those of previous years, with the near-term rapid growth reflecting rebuilding of herds after the extended drought we saw in the southern plains. However, while supplies of cattle have increased rapidly, we've also seen a worsening of pasture and forage conditions across the plains. That remains a concern affecting both the timing of cattle placement in feedlots as well as potentially breeding decisions in the coming months. If we compare the drought monitor right now to what we saw 4 years ago, we're still quite a ways away from the disastrous drought we saw in the southern plains back then. What does that mean for prices? Expansion in meat production for 2018 is expected to depress prices, continuing the decline we saw from the highs from 2014. Fed steer prices are expected to fall about 2%. Hog prices are down about 5%, broilers down about 3%, and milk down about 9% from last year, driven by lower product prices. All major categories are expected lower year over year. Butter and cheese prices show some decline, while prices for more export-oriented products like NDM and whey will reflect larger continued international supplies and competition. Of course, we see foreign markets increasingly important for beef, pork, and poultry and expected to grow over time. Those markets will also be important into 2018 to limit price declines and expanding meat supplies. Pork exports are expected to rise by 18% over the next 10 years and poultry by 14%. But look at dairy. Dairy exports on a fat basis rising by 13% and skim solids by 25% over the next 10 years. So again, more of a trade story. Again, I encourage you to come tomorrow morning and ask Undersecretary McKinney lots of hard questions. Turning to the farm economy, we expect farm incomes to remain flat, but the horizon may hold some room for optimism. As I mentioned earlier, as the Secretary mentioned, we're working hard on regulatory reform, tax reform, and the potential for improved trade agreements and investment in rural infrastructure will improve the outlook for farm operations. I don't include those in these slides. These are the current snapshot of what the farm economy looks like. If we turn to debt-to-asset ratios for U.S. farms, continuing to be relatively low, held down by steady, increasingly asset values, which reflect in part continuing firm land values. The debt-to-asset ratio has been slowly rising from 11% in 12 to forecast 13% in 2018. The current debt-to-asset ratio still is a long way from the 22% we saw in 1985. And without a dramatic increase in debt or loss in farmland value, the debt-to-asset ratio is unlikely to near that level. The more dramatic story as shown here is the working capital falling by 65% since 2012. And while the overall national debt-to-asset ratio remains low, when we disaggregate that by commodity specialization, we can see that producers are more vulnerable to continued low commodity prices, looking at data from USDA's Economic Research Service. We see about 1 in 3 poultry farm businesses and about 1 in 5 cotton farm businesses are highly or very highly leveraged, indicating a debt-to-asset ratio of greater than 40%. And for these farms, low commodity prices pose the greatest threat. Borrowing continues to rise. While rising debt-to-asset ratios are growing concern for producers, let's return to the issue of working capital. Following working capital indicates producers' resources are being stretched, leading to greater dependence on borrowing. Producers have reduced input costs where possible in recent years and increased income by selling inventory, but expectations are for increased costs as interest rates, fuel costs, and wages rise. We can see the current levels of debt are approaching the levels we saw back in the 1980s at more than $400 billion, with real estate debt expected to exceed the record of $218 billion set in 1981. While low interest rates have limited the burden on that debt for producers, interest rates as a share of net farm income have been increasing more steeply than has the debt-to-asset ratio. Still, at the current 26% of net farm income, interest payments remain well below the level of 60% we saw in the mid-1980s, but of course a serious trend that we're going to continue to follow. If we look at the share of non-performing loans, those on which payments are no longer being made, we see another troubling trend starting in 2015. Borrowers are finding it hard to maintain payments on both operating and real estate loans, shown here as upticks on the red and blue lines. While not as high as we saw in 2010 during the recession, still approaching nearly 1.5% of all real estate and real estate loans. Despite the increase in debt levels and rise in, a relatively modest rise in non-performing loans, we don't see anything like we saw for farm bankruptcies associated with the 1980s crisis. In 1987, 23 out of every 10,000 farms declared bankruptcy. Today, that rate is at 2.4 bankruptcies per 10,000 farms. So we can say that bankruptcies were still 10 times more likely 30 years ago and remain below the most recent peak of the last decade. All right, farm programs, bringing it home here. Congress will be looking at the 2014 farm programs, how they've worked, generated safety net for producers, and also look at the current economic conditions, of course. We saw some changes in the farm programs through the Bipartisan Budget Act of 2018 that I'll talk about briefly. Step back for a second. Over time, we've seen a movement from programs that controlled how much and what producers could plant to an array of programs, leaving producers a chance to make decisions based on market signals and their own risk management categories. As part of that shift, crop insurance has become increasingly important today, as average annual premium subsidies over the last 10 years have been at $5.7 billion, contributing more than a third of the average $15 billion per year in commodity crop insurance and conservation assistance that farmers rely on. Going to looking at the Farm Bill, of course, the impacts of the major disasters that the Secretary mentioned are still being felt. In 2017, producers had to bounce back from severe freezes, droughts, wildfires, 4 hurricanes, 3 of them Category 4 strength or above. Taking a look at this slide, we can see concentrations of increased crop insurance indemnities per county over the 10-year average. So this is relative to a 10-year average, with red showing payments 60% higher than average, Florida showing up there, of course, and the Northern Great Plains as well. Blue and purple here show average or above average production, and showing that payments were 60% lower in those counties, reflecting normal or above production in those areas. So we did see obviously a lot of issues facing producers, but also good growing conditions in a lot of the rest of the states. Looking at Farm Bill projections by commodity and looking at the major Title I programs, the most recent CBO baseline shows lower spending for most commodities, and that's just a function of how the programs are designed. Spending by commodity reflects primarily the distribution of base acres and projected prices and the way the ARC PLC programs work. Higher spending on corn, for example, reflected the fact that the ARC program made payments based on the difference between rapidly declining corn prices and a rolling average revenue guarantee, that it did incorporate those earlier years of peak corn prices into the benchmark guarantees for the first few years of the Farm Bill. Other base acre programs, commodities rather, reflect similar patterns. The effect of declining ARC payments can be seen as payments associated with wheat, soybeans decline over time. Cotton in red here was not a covered commodity under the 2014 Farm Bill, which is reflected in the fall of payments after cotton transition payments and cotton ginning cost share ended in 2017. The Bipartisan Budget Act of 2018 established seed cotton as a covered commodity eligible for the ARC PLC programs. For farmers with generic base, seed cotton base acres will be calculated as the higher of 80% of the generic base acres, or their average acreage planted and prevented for seed cotton between 2009 and 2012. Producers also may reallocate generic base to another covered commodity. Comparing planted acres of upland cotton to 80% of generic base, it appears that for many farmers, 80% of their generic base acres is higher than their average cotton acreage between those years, and so it's likely that some producers will choose to allocate those acres to a covered commodity that they planted on generic base over those years. As mentioned, we also saw some changes to the dairy program. The Bipartisan Budget Act allows dairy producers to cover production up to 5 million pounds at the $5 per hundredweight margin without paying a premium. And premiums on production history for higher margins were also reduced. So margins calculated in indemnities will now be paid out on a monthly basis as opposed to a bi-monthly basis. This new program is expected to increase payments by roughly $1 billion over 10 years, or $100 million a year. So dairy producers who enroll their production history in the program may receive higher payments in years when we have, obviously, low prices or high feed costs. Turning to the next slide, to conclude, there are a lot of factors that could shift farm incomes higher or lower. We know that economic growth, due to growing global economic growth driving demand for agricultural commodities, will boost prices. Farm programs as adjusted by the Budget Act or the upcoming Farm Bill may also be better designed to meet producers' needs under stressful conditions. The new administration initiatives for tax reform, reg reform, infrastructure are all expected to boost economic activity in rural America. However, we also expect ag productivity to continue to increase. That should keep supply ahead of demand on average going forward. We know that South America is going to continue to expand production of oilseeds and corn. Russia and Ukraine have been rapidly expanding production of wheat, corn, and other grains. And much of that increase in production will be exported, keeping prices competitive for most commodities. As a result, long-term expectations are for net farm income in the U.S. to fall in real terms, relatively flat. We continue to look to trade as a critical outlook for growing U.S. production that can sustain incomes boosted by a falling dollar and improve global economic growth. We do expect wheat and corn prices to be slightly higher next year and soybeans to remain steady. Continuing strength in export demand for soybeans, we expect soybean acreage to reach parity with corn in 2018 and to meet or exceed that going forward. Meat and milk production are forecast to reach record highs, and we expect to export record volumes as well going forward. The ag sector does face economic stress. Debt is increasing as working capital continues to fall. So farm programs have offered support to many producers weathering these economic challenges as well as natural disasters that hit farm country this year. I mentioned crop insurance already, but the Bipartisan Budget Act has also adjusted some of those safety net programs. We expect improved programs for cotton and dairy going forward with additional assistance with disaster losses. And this underlies my last slide here. I just want to note the folks at NASA hopefully will give me a shout out later that the 2017 U.S. Ag Census of Agriculture is currently underway. Right now we can see that we've received about 28% of our responses via the internet and another 69% via mail. This census will provide critical information to everyone on the U.S. farm sector, both at the USDA as well as in Congress, as well as other state leaders in agriculture, and help us craft more efficient and effective farm programs. Again, thank you very much for coming, and look forward to hearing other plenary speakers.